Hi everybody and welcome to the Middle Class Investor this week. Well, things are starting to get interesting as many of you have noticed in the market, and anyway, we're going to talk a little bit about it today. We're going to talk about potential risk in the market, and I'm going to show you some stuff from Elliott Wave. And anyway, we're just gonna talk in general about. I think what I'm gonna do is start with the Elliott Wave stuff, because there's some really interesting stuff in this study that basically indicates where this all might be going. Now, before I show you this, I just want to let you know that it's pretty shocking, and some of you may think, well, there's just no way the market could go down that far and correct that much. But what I want to do is I want to talk to you about how the market moves, and when it corrects, how where does it typically go to, and things like that. So without further ado, I want to show you the financial forecast. This is the Elliott Wave financial forecast. It comes out once a month, and you can see this came out. Its data is through April 5th, which I think is Thursday last week. So first of all, we talked about this. There's degrees of trend. Okay, so just to demonstrate real quick, let's go back to this. Let's pull up the Dow Industrials, and let's say all data, and let's get rid of volume, so that is not on the screen. Let's see, hide studies, hide volume. Okay, and let's turn log on. Okay, so notice this right here. This is I'm just going to count it out. A wave 1, 2, and then this whole thing here is 3. Now, the thing you can recognize here right away is that 3 is made up of a 1, 2, 3, 4, 5. And then of course you have 4 of this larger degree trend, 4, and then this last move up is 5. So going back to the Elliott Wave jargon, so you can see it says intermediate, primary cycle, super cycle. So we've just completed a grand super cycle wave 4. Now, just to kind of put this in perspective, in order to actually figure out where a grand super cycle 4 ends, I can't even show you, because you actually have to go back to England's data, where this trend started. Well, let's put it this way: the South Sea bubble was wave 1, and then the crash was wave 2, and then wave 3 has been, so I don't know, you can go on Wikipedia and see when the South Sea bubble happened, but it's a long time ago. So what happens when you have a trend and it corrects? Okay, so let's just look at the E-mini S&P futures. Okay, so the best way to show you this is on a smaller time scale. So let's look at a 15-minute trend, for example. Now, here's a pretty good example. You can kind of see a wave 1, a 2. This is actually wave 1, and then ABC, where ABC2 was a flat. This is 3, 4, and 5. Okay, and then you could see how far back this pulled. Okay, so let's pretend for a second this was the beginning. This was the run up to South Sea bubble, and then you had a 2, and this has all been 3, 4. 4 was the bear market that took place between 1968 and 1974, and then ever since then has been this. So 1974 till now would be this wave 5 move. So anytime you have a 5-wave move in Elliott Wave model, you get a correction. Now, you hear that term correction all the time in the marketplace. And a lot of times what the talking heads on TV mean by correction is if I pull up let's say a 2-year chart, okay? And let's say we're looking at this data right here. So this is clearly an uptrend, and then this right here would be a correction, okay? Now this particular correction was only, let's say from, looks like this was the high to the low. That was only a 4% correction, okay? This one right here, this is a daily chart, by the way. So this one right here was a 3.6% correction. So in talking head jargon, let's run this out to 5 years and look at a daily. This right here, if we zoom in on this area right here, oh shoot, I got my drawing thing on. Hold on one second, let me take that off. Let's zoom in on this area right here. So we ran up off the low, and then the market ran up. Let's see how far it ran up. We ran up from there to there, so that's a 17.19%, and then we had a correction of 6%. Okay, so this is normal market correction. The market goes up, the market comes down. But these are normal. These are intermediate degree, minor degree trend moves. Okay, so the corrections. First of all, this might not even be a 5 wave. So you don't even, maybe this is 1, 2, 3, 4, and then 5, and then a lot of times 5 can just extend, and you get 5s within 5s, and so on and so forth. But when you expand this out and you really look at a big picture, and then you zoom in to the individual degrees of trend, you get a study like you get from Elliott Wave that shows where we are at any particular time in this larger trend. So for example, if we were in the larger trend, and like for example, you could be in wave 3. Well, we were in wave 3 of the larger trend since 1932, or yeah, since the bottom of 1929. So, obviously we've been in this latest. Actually, I said that wrong. We've been in a SuperCycle degree move since 1929. So, suffice it to say, the only point in bringing all this up is when you're completing a larger 5-wave move, the correction, which is a correct term, is going to be in line with the run up. Okay, so if we had a supercycle degree run up, then we're going to have or if we had a grand supercycle degree run up, then we're going to have a supercycle degree correction. Bottom line, what this all means is that these moves could be very large, and I've been talking to you about the first move, which would be the intermediate wave move. It's going to take us down below 18,000, and I've been talking to you about that. The primary move should be below somewhere 13,000. But look at where the cycle degree A and the supercycle degree A, it's talking about below 3,000, and these are Dow numbers. Okay, this is Dow Jones Industrial Average. So let's go back to the chart for a second and look at all data. And let's kind of see if this makes sense. So 3,000, let's move, maybe we ought to move this line. Might be the easiest way to do it. Take this line, because I don't think this line's important for any particular reason, and move it down to about 3,000. And you're talking about this market correcting all the way back down into this area. So let's just draw a box just to kind of get the impression of the size of move we're talking about. Now let's go back to just a daily chart. Well, let's go to a 20-year chart, because see, it doesn't even show up on a 20-year chart. Yeah, we have to basically go back to all and daily, and then I'll just zoom in on this part right here. Well, see, it doesn't even show up. That's the problem. Is it's so large it doesn't even show up. So we're talking about, a move that is a significant move, um, and essentially that would wipe everybody out. I mean, basically, here's the problem with listening to your grandfather or even your father. Basically, anybody who's been alive has not been alive for the full grand supercycle move up, or even the supercycle move up. So they only know about pullbacks in the context of intermediate degree trend. These were primary degree corrections right here. This one and this one. This was the 2000 top and the rundown, the dot-com bust, and then we had a run up, and then this was the financial crisis. And these are just the way the market moves, and of course we assign names to them like financial crisis. But let me just show you, if I click here from the high, so we're already off the high, and we go down here to 3000. That is almost an 89% move. And if you know anything about the market, if you study the market and its history, what you'll know is that this is roughly 89%. So that happens too. You get this form 88.32. So you get this kind of form that shows up in the market that it repeats itself. Okay, so another 89% sell-off would take us down into this area. But obviously this is just going to wipe people out. Okay, so if you're not in cash or you're not somehow invested in a way where this doesn't hurt you, then you're going to get wiped out. So if you keep trying to buy the dips, you're just going to lose money all the way down. Okay, so you have to understand the context of the trend you're in, and just know this right here, this move from 1929, this is the cycle degree. This whole move is a cycle degree bull market. So we'll have a cycle degree A, which will make up a super cycle degree A, and then we'll have a cycle degree ABC, which will make up super cycle B, and then we'll have a super cycle C, which could be an ABC down, or it could also be a 1, 2, 3, 4, 5 C down. So this is going to be I mean, this is going to be devastating. I don't even know how to. I mean, not that I'm giving advice here, but if I were giving advice, I wouldn't even know how to advise people on that. What I'm trying to do is keep my powder dry, because it's not going to go straight down, right? We're going to have places along the line. Like if we get A, B, C down here, well, you'll be able to buy at the end of A and ride B up. So maybe A goes down 60% and then B goes up 30. Well, you'll get to make money going up 30, but then you need to be on the lookout for the next wave down, C. So we're talking about maybe a 3 or 4 year affair all the way down to this area. And then probably what will happen is we'll get some sideways type correction, which you can be long in, and it could last, well, certainly all of my lifetime, and maybe even as long as 100 years. So who knows? I mean, we don't really know how long a sideways triangle of super cycle degree could last. It could last a long, long time. It might be like the dark ages for the United States or something. All right. Well, enough of that doom and gloom. Let's bring it a little closer to home and talk about just kind of what's happening in the market right now. So, excuse me. One of the things that's interesting is the Dow, you can see right here, actually made a lower low than the February 9th low. So this low here is lower than this low, which tells me that this is likely the start of a bear market. So this could be a wave 1, a wave 2, another wave 1, another wave 2. We've got another wave 2 maybe up into this area around 25,000, and then it should be the end. Kiss it goodbye. But this whole move down is just going to be wave 1 of a larger 5-degree wave. So we'll be watching it closely here. I'll be following on Elliott wave. Deneric also, I think I've shared this with you before. This guy Deneric's Elliott waves, he does a really good job of charting, I think. And I believe he's showing essentially the same thing. Yeah, so see, he's showing a 5-wave move down to here, and then you can see a pretty deep correction in 2, and then we've got another 5-wave move down here into this early April low, April 1st low, and run up, and he's saying maybe 2 is completed, or maybe we run up back up to the channel, or maybe close this gap and then down. So I would look for, but this is not going to take long. I mean, I would look for maybe some bullish this coming week, and maybe the following week it rolls back over and starts to go down. So you got this week to pick a place and kind of step to the sidelines if you're not there already. But here's the thing. I mean, this was about a 10% down right here, and if you can get out right in here, you're talking about a 3, 4, 5% loss in your account. That's pretty darn good. Really good if you have a 401k. If you can miss the biggest bull market of American history and get out with only a 5% loss. So, but anyway, this is pretty startling stuff here. Below 3,000, you can see the advice they give: hold cash or short fund. So in the intermediate wave, you can use a short fund like SDS or something like that. So if some of you wanted to buy the SDS next week, that's a 2 times the S&P down. So if the S&P goes down 5%, the SDS goes up 10%. But notice, as you go to these larger degrees, they don't recommend using these short funds. And a lot of that has to do with the fact they think some of them are going to go bankrupt. They're just going to fold up shop. So don't kid yourself in thinking that you can hold one of these short funds through this whole thing. You really shouldn't press it. Maybe you could press it on this one, but I don't know that I would try to hold it all the way to the bottom, because it could just file bankruptcy, kind of like a company would, and then you lose all your money. So, and here's somewhere in here, and we'll talk about gold in a minute, or we can talk about it now. But as the market starts to sell off and the government starts to respond, initially you should have some strength in the dollar. That's normally the way that works. Let me find the dollar here. Do I not have the dollar? I may not have the dollar here. I think it's dollar DXY. So you can see the dollar. You can see it's kind of trying to bottom here, and maybe it already has. Maybe it makes another low. I'm not sure. But as the dollar runs up, let's say this is wave 1, and then we get a wave 2, and the dollar runs up and it starts making new highs. If you look at the dollar over the last 20 years, for example, well, I can't go back any further, but there has been times when the dollar is much higher than this, but you can kind of see here, this looks like a wave 1, 2, 3, and so we're going to have some sort of 4, where the dollar runs up and then down. It's probably going to be a triangle, and then the dollar is going to make a new high up here. This is probably going to coincide with gold making a low. So, holding cash right here, through here, you should, everything you buy should be cheaper. So it's not a bad idea to be holding cash in these later periods. But at some point, there's going to be a great time to buy gold or silver. Probably silver, and this is just in case the money just goes bad. Okay, but I would look for silver. You know, it's almost down here, and it may not get all the way down to this level down here. It did get to the level, but it may not revisit the level. It may just go up from here. But you know, I could easily see silver making a move up to 23 as the dollar runs up in a wave 4A, and then you might see it pull back and then pull back again and kind of chop and then take off again. And then when the government starts to respond to what'll be a lot of pressure from society, they could end up destroying the dollar, which silver then could just take off, and who knows how high it could go. I mean, if you look at a 20-year chart of silver, if this is just wave one up to 50, and maybe silver pulls back all the way back to here first to at $7 or $8, but the next move on silver could be well over $175. So at some point when the dollar begins to weaken, you need to hold some sort of precious metals to protect your wealth. Silver and gold have been in demand for to trade goods and services for more than 5,000 years. So I think it's a pretty safe bet to go ahead and buy some. Now you don't have to put all your money in it, but you want to have a little bit. So gold and silver, I mean, they both look like this chart. Silver looks a little bit more extreme. Gold's not quite that steep. Well, it's steep, but it hasn't come down as low yet. So, but it could. I mean, we're looking at gold coming down here. Here's the previous fourth wave low is right around $700. The previous fourth wave low on silver is let's see, why does my silver chart look like this? There it goes, it fixed. The previous fourth wave low is right here. So right here where I've got this 798, and those could go pretty high. So anyway, we beat that to death. Let's go back and talk. Let's go back to we haven't really even talked about the S&P 500 yet. Let's put that on the chart and zoom in, do some drawing, and talk about what we're likely to see in the market here. So right here's what Elliott wave says. Once you have 5 waves in the direction of the trend, that didn't work right because it's so steep it thinks I'm trying to draw a let me draw it right there. It's just not going to work. Alright, well, let me exaggerate a little bit. So it's just not going to let me do it. Bottom line is here's the wave 3, and you can see 4 up to here, and then 5 down to here. Okay, so that's 5 waves, and once you get 5 waves in the other direction, then that could mean that there's a potential trend change. But what are we really looking for on a trend change? We're looking for, we've got a high, okay, and then we have a low, okay, and then we've got a higher high, or excuse me, a lower high, but we don't quite have a lower low yet in the S&P, but we do in the Dow. That's why I showed you the Dow. It turns out the Dow is actually very important for this kind of work, but the S&P is important too. And I would say within pretty short order, we're going to see a lower low in the S&P 500. So once we have a lower low, now we have a trend change potentially. So what you then look for, you kind of draw a line, kind of like Deneric did, and you look for this to to make its way up into this area, or close this gap, or both. Okay, so there's a gap there. And then this next move down should be very, very, very aggressive. And it should look like the middle of this right here, this part. Should look a lot like this part right there. Or let's do this. Let's put a box. This right here is the wave 3 of this wave 1 down. So you can see how much more violent this is. I mean, wave 1 and 2, there's nothing happening there, but then look at this, and then this, and then this, and then the reversal. So you're going to see this kind of action over here, but it's going to go much, much lower. You're talking about, well, in the S&P you're probably talking 500-600 points, and on the Dow you're probably talking 5,000-6,000 points. So we're talking about big moves. So just make sure you're on the sidelines so you can sleep at night and you feel better and not anxious about what's happening in the market. All right, let's go to some of our normal places that we look at, like volatility. You can see we had this big spike in volatility a while back. We've talked about this. It ran up into the 50s, quickly sold back off into the 19s or 20s, something like that. Right, a little bit. I mean, the next move in volatility is going to be much, much higher. It's going to exceed this 50 mark. One of the reasons this drops off so fast is because of people buying the dips. You know, what happens is if you look at let's say 10 years, okay? What happens is every time the market runs up and then it pulls back, that's a dip. So people buy that, and then it runs up, and it pulls back, and it dips again. They buy that, and this works over and over. I mean, look how many times this works: 1, 2, 3, 4, 5, 6, 7. You know, people start developing a habit. So what they do is they buy the dip again, and there's nothing wrong with buying the dip and being wrong, but you just have to. If you're wrong, you have to get out. You know, you can't just be wrong and go, well, I bought the dip, and then it keeps selling off and keep buying more dips. If you do that, eventually you run out of money and the market will take all your money. So the buy the dip crowd, when you're in a when you're kind of in a topping process, you know, there's people buying the dip here, and it runs up, and they buy it again here because they think, oh, okay, it's a double bottom, so they buy it here, and then it runs up a little bit and then sells off dramatically. So a good trader, good investor, if you are buying the dips, and it's perfectly okay to buy the dip, you're buying the dip right here, and you get rewarded, right, in a run up. Excuse me. And then it pulls back, and you buy the dip again, and you get rewarded in a run up. But this time the run up starts to roll over and come down. Well, once it comes down past your entry, right in here, I mean, you're out. Okay, so you're at this point you're wrong. I'm wrong. It's no longer buy the dip. This is something more dramatic. Boom. Okay. Hopefully that makes sense to everybody. That's what we mean by discipline. So if you're talking about, well, if somebody says, well, I'm a disciplined investor, or I'm a disciplined trader, that's what they're talking about. They know where they're going to be wrong, and they're getting out. Okay. All right. Let's look at the short-term Treasury yield. Take it back off log scale. You can see we're still above this line. We're in some sort of fourth wave pullback on yields, so we should get a bounce right here, and it should take us well north of 2%. But then we're going to get a pullback again. I don't know if it'll be very deep or not, but you know, the yields aren't just going to fly, you know, right out of the gate. They're going to, I mean, they will, relatively speaking. But I think what you'll see, you can kind of see it here. This looks like a 1. This looks like a 2. And then here's another 1 happening. So we could have a 2 pull back into this area. In fact, let's just draw that. Let's draw that on the chart. Let's put a box. So once we run up, and you can see I've got this 3.1 area drawn. But once we get up to 3.1, you're probably going to see yields pull back into this area around 2.5, 2.6. Somewhere around this support area. So if you draw a line here, so we draw a line across these tops right here, you can see how that coincides with our yellow box. So once we run up into Once we run up into this area, then we'll probably get a um, pullback down to here, okay, before we run up again. So just be aware of that and prepare for it. Sorry about all the clicking. I'm trying to get the extension off so that there we go. So we'll probably run up in here next couple of weeks, next 3 weeks, maybe even 4 weeks up into this area, and then we'll have a multi-month pullback into this area. So before the trend really takes off. That's just what it looks like to me. It may not happen that way, but that's what it kind of looks like to me. All right, let's just take a quick look at the Germany. Germany looks a little bit weaker than our market. Japan looks about the same as our market. United Kingdom looks the same as our market. So that's really all we're looking at now. I mean, if somebody wants me to comment on that more, just leave me a note and I'll comment on it more. But really, I think what we're going to experience here is a global phenomenon. Companies, I mean, the big 9 or 10 world economies have been printing money like crazy and buying bonds and doing all the same thing our Fed is doing. So basically, we have a sugar-induced or a heroin-induced, market, and when we come off that, it's going to be pretty devastating. So just we've talked about how to weather that storm, and just be careful. All right, let's switch back over to charts again, and let's look at oil and some of these others. All right, let's look at. We already looked at gold and silver. Let's look at the euro and zoom in a little bit. Maybe zoom in a little bit more. And basically the euro is getting choppy here. And anytime you have a situation like this where it's trading sideways, it's going to resolve itself either up or down. Now I'll just tell you that in Elliott Wave they think it's already reached the top. So maybe we get a little burst like this up and then bam, down. So if you're trying to short the euro, if you're trying to be short the euro US dollar, maybe you look for a little rally and then try to buy up in this area and hold it, because if you can hold it down into well, it's probably not going to slow down until it gets here, and then it'll rally a little bit, chop around, and then make another leg lower. But if you want to try to ride it down in this area, I mean that's a pretty good trade, so you can make some decent money on that trade. All right, US dollar CAD. We talked about this the other day. The US dollar should be strengthening. We see we broke this downtrend line. We're pulling back. And let's look at a daily chart real quick and see what that looks like on a daily, because it may already look like an ABC. Maybe great time. Yeah. See, this kind of looks like an ABC, and I would say a break above this area right here, this 1.2797. In fact, let's just put that on the chart. I would say I would be long the US dollar CAD. So you want to be long probably the US dollar CAD. If it actually, you don't even have to wait till it breaks this larger candle high. You can just, once it closes above that little candle that's inside the larger one, here, let me zoom in. It's hard to see. Once it closes above this candle, so the next bar, if it closes above this candle right here, you can be long this and trade it at least to up to this point up here, up to the 131 area. And if you wanted to just hold it longer, you could hold it longer still. But I would wait for a close above 127.88, and then be long the US dollar CAD. All right, let's look at the Great British Pound US dollar. If the US dollar starts if it starts getting stronger, which it should, that should bring this this instrument down. get right on the right pointer here. You should see this start to move down, and I would say it would move down into an area around this box right here, somewhere around there, and then rally, and then maybe go lower again. So um, I wanted to buy, as you know, I wanted to buy the British pound back in here, and I had an opportunity, and then it got away from me, and I just never did do it. But so you made some pretty good money if you were in the British pound US dollar through here. All right, let's look at oil. Oil, you know, is trying to chop lower. I think oil is done moving up, but I thought it was done here when it made this move down. So this looks very corrective to me. So it made a move down, and I haven't dug into this to see if this is a five-wave move. It looks like it could be, but this looks very corrective to me, especially this area right in through here. It's very choppy, and not only that, but this candle here overlaps these peaks here. So this could very well be an ABC, and we've started the next move down in oil. Now, if that's the case, I mean, oil should go quite a bit lower. You know, maybe all the way down to this area here around $45 down here at the bottom. So I would look for, you know, I certainly wouldn't be long oil. If you look at ExxonMobil and Chevron Phillips and these kind of companies, they've already started to roll over. They rolled over weeks ago. So I would stay clear of oil and oil stocks right now. But there'll be time to buy oil and oil stocks. It's just not at this moment. All right, I think that's about it. I'm going to leave you again with this page. Below 3,000, you know, cycle degree, bear market. That's not something you can hold through. So when you call up your broker and he tells you, oh, you're young, you know, you got plenty of time. Look, most of us alive today bought or put money into the Dow or put money into the market when the Dow was much higher than 3,000. If you just remember the dot-com, you know, the dot-com era. Let's see what the Dow topped. Let's pull up the Dow. Wheel. Sorry about that. Okay. So if we just look at let's go back 20 years. Yeah, let's just do it all. Put back on log, and we'll zoom in to here. So, you know, I graduated college in 1990, which is right here. And of course, I didn't have any money in 1990. You know, but if you look at where the Dow was in 1990, it was 2,900. Roughly. It got to 29, what is that right there? It got to 2938 in 1990, the year I'd graduated. So, which is amazing. It's hard to believe that it was that low then. But let's say you got involved with the market, you know, in this area right here. Well, that is 5,500. And my guess is you've probably been making more money along the way, so you've put more and more in as we've gone. And so maybe you put money in right around here where it was 10,400, or maybe you put money in here where it was 7,500, or maybe you put money in here where it was 12,400, or maybe you put money in here where it was 7,500. The point is, almost none of us listening today put money in the market where this yellow box is. Okay, so suffice it to say, if the market pulls all the way back down to here, you would lose everything you have. So you cannot afford the pullback of a super cycle or even a cycle degree trend. You just can't afford it. I mean, this was primary degree right here, and they were saying this was the worst recession since the Great Depression. So, and that's only primary degree. So let's go back and look at Here's primary degree right here. We're talking about cycle and supercycle degree. So, in other words, we have begun a grand supercycle wave 4. So remember what I said. Once you have 5 waves, and this is the end of 5. This is the end of 5 of supercycle degree. But it's a grand supercycle 4 is what's coming up. So that means it could make an ABC and be over, or it could make an ABC down, ABC up, ABC down. In other words, it could make a triangle. So or it could make a flat, so it could come down to ABC and then make an ABC higher, but only be 3 waves, and then make a 5-wave move down. Could do that. There's a lot of different ways this 4 could play out, but the odds are that it's probably going to be a triangle, in which case A will be the largest and the longest wave. So it's likely to be an ABC down to here, okay? And then it won't go any lower than that. Because hopefully I'm making myself clear, but maybe I'm not. So let me explain a little further. Let's say that this grand supercycle 4 resolves itself in a triangle, okay? So maybe it looks something like, well, I'm not zoomed in enough, but let me try it again here. If I could get all this on the screen. Yeah, there we go. Okay, so let's just speculate a little bit. Let's say it's A. Let's say we get A all the way down to there, and then we get B like that, and then we get C to there. Okay. Well, then you get an A. Okay, B, C to there. So this would be A, this would be B, and then we get a B, C to there. Now we got C. We get an A, B, C to there. Now you can see the slope of you can see this triangle forming. So you get an A, B, C, D, and then you get a little E, an E down to about there, and then boom, this is the grand supercycle 4, okay? And then grand supercycle 5 begins. And I doubt anybody listening to me today will be alive to see this whole formation. But you can see where the most damage is done, and is in wave A. Okay? And obviously, if the market sells off to here, we can look to get long here because there's going to be a lot of money to make right here. But then we need to be cautious, and we need to be looking for the next leg down so that we're not in the market during this section here. And then again, when it bottoms around here, well, we want to go buy, great companies like Hershey and Walmart. And I mean, who knows? You might be able to buy Walmart for $5 a share here. I mean, if you could, that would certainly be worth it. And then, in other words, we want to try to capture, in your 401k, you want to try to capture these moves up. All these moves up like this, okay? But you don't want to be in this right here going down. You don't want to be in this going down. You don't want to be in this going down. These are big moves. Okay? This could be 90%. Now obviously this next move down is not going to be 90%, but it might be 30 or 40. And who wants to live through that? Okay? So this is kind of how it might look. Now it could look some other ways too. It might not look this way. This is a highly probable way for it to look because this is what catches the most people off guard. This is what destroys most of the wealth, is this first move down, okay? And that's typically the way the market works. It tends to do whatever hurts the most people at the proper time. All right, well, I realize that's kind of negative, and so I don't mean to be negative. I just want to make sure that people are careful and they're protected, and they at least know. Okay, if you If you're listening to me and you go, hey, this guy's crazy, he doesn't know what he's talking about, that's fine, but now you've been told and you know. So you can either take action or not, but at least you knew. All right. That's it for this week, and I'll be back next week and we'll talk some more about this. I suspect next week we'll see some more development in this, probably to the bullish side is my guess. Probably up here to right around 25,000, maybe a little bit lower. And we'll be looking for the next leg down. All right, everybody, thanks for coming in. We'll see you next week. Bye-bye.